welcome to Money Matters. My name is Jim Butler with Wealth Enhancement, and my colleague this evening is Mike Dever with Brandywine Asset Management. Welcome, Mike.
Oh, hey, Jim. Thanks.
How are you?
Doing good. Yeah, I got a little hotel back room for me today. I'm in Denver. So
Okay. All right. Well, scouring the U.S. at least for opportunities, I take it.
Yeah.
So, as you and I know, we don't like to date ourselves with the show. However, as we approach the end of 2025, one of the inevitable things that we just came through is the election cycle. Now, it's an off-year election cycle, depending on how you look at it. And my point of bringing it up isn't in any kind of prediction or how things turned out, but rather the questions and level of uncertainty that can create in the minds of business owners and investors. Do you hear that periodically from people you come in contact with?
We've been in a pretty unusual period for the last 2 years, year and a half, certainly now, where people's view on the economy, the markets, is very much influenced by their political views. And so bringing up the fact that we had these off-year elections, and you had what could probably best be described as sort of a favorable showing for the Democrats. There's people that'll view that favorably and people that'll view that unfavorably. But it's really split. It's more split than I've ever seen, I think, in my investing history, as far as people basing their investment decisions and market outlook and economic outlook on who's in the White House, with the Trump supporters viewing that as a positive, and the Trump antagonists viewing it as we're in the worst position we could possibly be in, and the market should all collapse.
And there's no shortage of questioning what's going on behind the scenes. So beginning of this year, of course, there were tariffs that entered the picture, and by some count, you would almost think the world was coming to an end. Fast forward to where we are today, the world did not come to an end. And I'm not meaning to be silly there, but that is a contributor to that level of uncertainty that we're touching on. And then you look at interest rates and what the Fed has finally started to do in terms of beginning their lowering cycle in order to provide more liquidity in the markets. One thing that I researched recently is the impact of those uncertain developments. What does that mean what has that meant this year in the markets? And if you recall, because of that tariff discussion, initially between February and April, the market sold off. And using the S&P 500 as an index, in early April, we actually had a minus 15% in the S&P 500. The NASDAQ was down 18. International equity, the EFA index, was down about 3.5%. However, fast forward to last week, those returns were much different. The S&P was up almost 18%, NASDAQ up over 23%, and the EFA has been up over 28%, again, on a year-to-date basis. So very short-term time period, from what happened initially in this year and then how things have played out as the year progressed.
Yeah, no, it's definitely we're in a bull market. And in a bull market, anytime you have a market sell-off, it's an opportunity to buy. Everybody's been recognizing that. Even though you have talks of bubble, there's still such a fear of missing out. Even if we're in a bubble, it's just going to inflate it more, because people don't want to missing out on that final stage of that occurring. So it's, right. You can only describe it as a bull market.
Right.
This is how bull markets behave. Bad news is met and cast away pretty thriftily, and that's what we've seen here.
And is it reasonable at the same time, Mike, that given how well things have turned out, not only in 2025, but also the recent past, that at some point there could likely be a consolidation? The market could pull back on a short-term basis. Do you see that as a possibility?
Yeah, of course there will be. The market's going to fall 30 to 50% sometime in the next few years. I mean, it has to happen. It's what happens. And we're at a point where if you look at valuations on historical measure, the next 5 to 10 years aren't supposed to be good, right? When you hit extremes in valuations, there's always a reason why that happens. In this case, the reason is AI. AI is going to help with efficiencies and increase productivity, and we've got a lot of money pouring into it. It's going to be supporting jobs and just economic growth. That's the belief, but that's also why any overvaluation period forms. There's always a rationalization of why that should be behaving the way it is. We're in that period now. It doesn't mean it can't be like 1999 and the market doubles from here. Like NASDAQ did essentially in 99, but it could also be like 96 or 2000. You really don't know. But right now we do know that on a valuation basis, the market's rich, and that over the next 5-year-ish period, that pretty much indicates less than average returns. What people are expecting right now is just unreasonable. I've had clients call and tell me that they just want to get 20%, as if that's got to be right. I mean, they say it, I just want. They say it with those words as well. So to them, it's like expected. And here you are, almost 20% again this year, 20% last year, 20% the year before. So people are expecting that to be sort of a norm. You look back over the last 10 years, 16% is the S&P's average annual return over the last 10 years. That's just, we don't have the sustainable economic growth to make that happen. And you can see it because its valuations have blown out. The actual earnings haven't kept up with the pricing.
As I'm listening to you, I'm thinking of something we hear a lot about today, and that's, the work-life balance, so that people don't necessarily have to work 80 to 100 hours a week, but to be productive at work, have a good family and home life at the same time. So there's that work-life balance. And then the balance in a portfolio, it's called that risk-reward trade-off. In order to get 20%, it's available, but you have to be willing to take on a little bit more risk and likely illiquidity in order to reach those higher levels. So, a diversified portfolio can allow for part of the investment sleeve, to achieve those higher levels, but that is above average.
Yes. Oh, yeah. We're probably 60% above average annualized returns over the last decade. And that has what's led to the valuations. On the work-life balance, it is interesting now that we're starting to hear more talk again. I just got a text from my son, Charlie, last night at midnight, who just started on Monday at XAI. And he said, just finished my first 15-hour day. And so that's part of what's driving these companies in this economy now. They have hundreds of billions in invested assets, money going into them. They need a return on that, and they're driving people hard.
Yeah. Well, good conversation. How about if we hop to the question? I know we have folks that write in, and Martin Ackerman in Philadelphia is asking the question, Mike, what are the advantages and disadvantages of ETFs?
Okay, so Martin, ETFs is just another form of a fund, a pooled investment vehicle that you can go into. So mutual funds, ETFs, they have similarities. The difference is with mutual fund, they price at the end of each day. With an ETF, it trades like a stock. So throughout the day, you can be buying and selling that ETF. That's one of the benefits and one of the disadvantages of an ETF. Generally, people learn, and the data shows that the less trading you do, the better your returns will be over time. So having the ability of trading on a moment's notice, market sells off, you panic and sell out. That's a disadvantage on the ETFs. As far as what they invest into, ETFs today are almost identical to what you get in a mutual fund. So for example, we're launching an ETF suite next year. It's just going to mimic what we do in our 401k plan funds. There's no real limitation. When ETFs first formed, they were a lot of passive investment vehicles. But now there's active trading going on in ETFs, just like there are in a mutual fund. So the vehicle itself, ETF, has some advantage, disadvantage again by the frequency of trading that you can do in it. But as far as the type of investments that they make, that's not dependent on whether it's an ETF or mutual fund, for example. That's dependent on the individual manager that's managing that ETF.
Are there cost difference in ETFs?
You know what? So generally ETFs came in at lower cost than mutual funds, and mutual funds have been coming down a lot lately as well. So they're starting to sync up a little bit more. I would say on average, it seems like the ETFs come in a little cheaper for a comparable product of a small cap value fund. You can get some less expensive active ETFs than the active mutual funds might be. And on the passive side, I mean, you're just paying basis points for a lot of funds that are in the ETF structure. So they might be a little bit less expensive, but it's not dramatic.
Right. Good. Well, thank you, Mike. Good answer. And if you have a question you would like our panel to review for you, here's how you send it in.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Our guest this afternoon is Chris Corgnati of EOS Worldwide. Welcome, Chris, to the show.
Thanks, Jim.
And I think a good place to start, in no particular order, I'll let you decide, is first help our listeners to understand what is EOS, and then maybe a little bit about your background that qualifies you as an expert in this area.
Sure. Thanks, Jim. So EOS just stands for the Entrepreneurial Operating System. And what it is, it's a framework on which you run your business. It's a complete set of simple tools that we implement with the owners and leadership teams of our clients. And it is about blocking and tackling basic execution of how to run a great business. How I got to this point, go a little bit further back. I spent 25 years in the Navy, most of that time flying airplanes. I was a naval flight officer in the P-3C Orion aircraft. Was fortunate enough to command a squadron of 400 sailors and 10 airplanes flying around the world doing interesting things. And at the end of my time in uniform, I ran the Navy's airborne intelligence programs, which included all the unmanned aircraft and drones. So I ran about a $2.5 billion a year portfolio of programs. So when I retired, sort of a natural transition, I spent the last decade plus running 3 different startups in that drone manufacturing and service space. And so been a COO, a CEO, a board member, sort of seen commercial and military from small to large. So a good amount of experience of what it takes to run one of those companies, and sort of combined what I missed about being in the Navy and building high performing teams and coaching and mentoring with what I learned in business. And with EOS, I get to combine those and go in and help small companies to really get everything they want out of their business. We talked a little bit about work-life balance earlier, and for some people, they're looking for more profit, more revenue. For some people, they just want to get a handle on their business so that the business isn't running them. So maybe their metric may be time. They just want to get time back to be able to go to soccer games and Little League games. So awesome opportunity to help businesses here in the local community.
Well, first, Chris, thanks for your service. You put in a lot of time there, and we appreciate that. And I mentioned my son at XAI. He just left the Navy to go to XAI. So, I really appreciate.
Mike, I was only supposed to do 6 years, and somehow 6 turned into 25. So.
Wow. Well, you must have enjoyed it then. I mean, you got fulfillment out of it, obviously.
We did.
To spend that time there. Now
you talked very supportive wife as well.
Yeah, right, exactly. Yeah, I'm sure you're moving around and seeing different areas all the time.
Yeah.
But the system. So you have a system Is that something that's mechanical? I mean, that any company can plug into and improve their processes or their profits, or what's the end goal? Is it just to increase profits for the company, make them more efficient, and increase?
Yeah, there's 6 key components that we work on. We start with vision, and that's just about getting everybody aligned and on the same page about where you're going, how you're going to get there. We talk about people. You go back to sort of the Jim Collins good to great, getting the right people on the bus and getting the right people in the right seats. We talk about data, which is about making really intelligent decisions based on facts, figures, and not subjective emotions and ego. We talk about how you solve problems. Now, a lot of companies and leadership teams will sit around and talk about an issue and never get to a solution, never get to the root cause, and never actually solve anything. So we work on that. We work on process, which is about getting consistency and scalability in your business. So you're not, you're getting the most important stuff done right the first time. And then at the end of their last is traction, and that's discipline and accountability, so that everybody is executing on your vision. Everybody's rowing in the same direction. It is not an actual, mechanical or software package. There are third-party software packages that can help you run EOS, but quite honestly, you can run EOS on a pad of paper and a pencil. It's really about the thinking of how you attack problems, how you run the business. It's blocking and tackling and daily execution.
Chris, are there any particular sectors or size companies where EOS works better than others, or is it much more universal?
Yeah, great question. On the industry side, very much agnostic, very universal. It's starting to grow a foothold also in the nonprofit world. So it's really any organization. Nonprofits are a little, they've got their unique attributes, which you need to account for, but the system still works in just about any organization. Size-wise, we tell people about 75% of our clients are 10 to 250 employees. We've had as small as 1 and as big as about 8,000. And I saw actually a conversation on our Slack channel the other day that apparently the biggest revenue company we've seen is a $15 billion a year company that runs on EOS. So, but again, the sweet spot for us is that small entrepreneurial company that's scaled to a point at which they, brute force no longer works, right? As a founder grows a business and starts and just sheer force of will has grown a business to $2-3 million. Now it's like, okay, what do we need to do? We need to actually build the leadership team. We need to put the processes in place. We need to make sure we've got the right people to really start to grow and scale. And so that's sort of the sweet spot. And the caveat I always tell people, it's like anything else, is the leadership team has to be open and honest and willing to change and want to change, right? I can get you the greatest coach at the gym, but if you don't want to be there and you're not going to put in the work, you're probably not going to see the results. So it really gets down to that leadership team and their willingness to embrace it, put in the work.
Do you end up then serving in like an HR role and a C role in a company, or do you bring other people in? Do you have HR firms you work with, for example?
Yeah, no, that's a great question. And what I and most EOS implementers, and we share this kind of information amongst our peers, is we have an ecosystem, or a Rolodex of lawyers, fractional HR folks, fractional CFOs, investment funds, M&A folks, exit planners, those kinds of things that we can offer just as referrals to our clients when those things come up in the course of us working with them. But we always make the point right up front with people is, hey, we're not consultants. We are teachers, coaches, and facilitators. And so we were going to come in, we're going to teach you EOS, we're going to hold your hand until you're ready to walk and run on your own. Then we're going to get out of your way and go help another company. So our average engagement is about 2 years, and that equates to about 13 full day sessions spread over 2.5 years. Is sort of the normal cycle when most folks are ready to then graduate. Some decide to keep their implementer around for their quarterlies and annuals beyond that, just because there's value in having an outside look at what you're doing. But some just graduate and run EOS by themselves for years and decades.
Okay.
2 years is long enough time period where you've experienced some frustrations, I'm sure, working with business owners and their executive teams. What are some of those common frustrations that either you've experienced or they've experienced as well?
Yeah, I think the common frustrations that lead people to want to implement EOS or try something else in their business is, either they've sort of hit the ceiling, and they've grown it as much as they can, and they're frustrated either with revenue or profit. The time component, when if you just don't have enough time and the company's running you and you're working those 80-hour weeks and it's only sustainable for so long. And people are always a challenge. People will get frustrated, and those key hires, you can't spend I think enough time to make sure you're getting the right people. That's hard. And I've experienced it in hiring for the companies that I ran. I always waited too long to make key hires, and I always kicked myself afterwards for waiting too long. I think some of the frustrations that I've seen are just with clients who they know they need help. They've asked you to come in, you've put the system in place, and they're just not following it. And so it's the teaching where you come in, and it's the coaching aspect of it is much like, you played sports in high school, and I used to tell my son, hey, when your coach stops yelling at you, that's when you've got a problem, because he doesn't care about you improving anymore. If he's in your face and he's yelling at you and telling you what you need to improve, that's a little bit, we get in and ask the hard questions. We ask when we get in the session room, part of our job is to challenge the team and ask hard questions and to make them get better, because otherwise, why are they paying us? And they're wasting time and money if they're not going to put in the work, and we're not going to push them to be the best that they can be.
It's interesting you talk about the starting out with the shared vision, everybody having the shared vision, and then the slow on the hiring or not hiring side. My experience with that is so true to what you're saying there. The vision is everything. I had a company where I was bringing people in, and they would interview with other people and come to me at the end. And I had one that I guess everybody wanted to hire. And when he went back, he said, I can't take the job. And the guys came up to him and said, well, what happened? What'd you say to him? We had him. He was going to start. And I said, I just told him what the work environment was like here and how, energetic and everything was.
Oh, I lost Mike.
And his eyes just glazed. Hiring has always been too slow, or the firing's been too slow.
Yes.
I find that. And do you see that people delay too long in hiring the key people they need?
Yeah, and the firing piece as well, right? Because it's an emotional thing, and especially in smaller companies, and if there are people that have been there a while and they've helped you build the company and you have loyalty to them. But if they don't meet your core values and they're not a fit for the company, you got to make the tough call, and you got to move on. And like any the key hires piece it's always money driven in smaller companies, right? It's like, hey, when do we want to invest the money? I heard a great quote. I was at an event 2 weeks ago, and the quote was something to the effect of, if you make the right hire, they're free at any price. So if you're getting the right people, the value they're going to bring to your organization, they're going to pay for themselves regardless of what compensation package you give them. But you're not going to hit that 100%, right? It gets back to what you said, is you got to be ready to let people go if they're not doing what you need them to do and they're not helping you grow the business.
Absolutely.
Chris, that kind of ties into a thought that I had as I'm listening, which are headwinds. Are you experiencing any headwinds in the markets that you serve?
Sure. I mean, a lot of them are the same that we were talking about before in the stock market and working with your clients, is political uncertainty, economic uncertainty. End of the year, people are starting to figure out, starting to look at what their end of the year numbers are going to be, and maybe they don't want to invest in EOS now. Maybe January is a better time. So working with people, to use the old cliche, the best time to plant a tree was 20 years ago, and the second best time is today. And so we just try and get people, answer the question is, okay, what's going to change if you don't do anything? And then tell me a time when you didn't have economic and political uncertainty. We may have it to a different degree right now, certainly with the tariffs, and they were in front of the Supreme Court talking about tariffs today. So that's certainly an added layer of complexity. But there's always a baseline level of uncertainty in life and in business. So I just encourage people to try and put it behind them and make the best decisions you can make today and just get started. Because the longer you wait, there's an opportunity cost to doing nothing. I guess it's probably a good way to put it.
Chris, can you give us we have like 2 minutes left or so to give us a quick example of one of your success stories, the company you went into where they were struggling, how you helped them recover, and what was the result of that?
I think it's a little bit different depending on the company, but a recent example is a small company, less than 10 employees, and the biggest thing that we were able to do with them is when we went through that vision building exercise is to get everybody on the team to understand what the 10-year target was. What's that long range business goal that we're all shooting for? But then we back that down to our 3-year picture, our 1-year plan, and our quarterly priorities, what we call rocks. And it really, the light bulb went on for all of them. They said, okay, so what I do today matters for the month. If we win the week, we can win the month, we win the quarter. And it starts to build. So that vision, that long range vision, and bringing it back down to no kidding, what are we doing in the next 90 days was transformational for them. And then I would say another one of my clients, when we built their accountability chart, forcing them to figure out the structure of the company going forward. What did they need in the future? They had a sort of a jumbled org chart that they had pieced together over the years, and forcing them to get rid of, we scrapped it, start from scratch on the whiteboard. A year from now, what do you need to look like to grow to where you told me you want to be? And that for them was probably the biggest aha moment. So I think those are two quick examples.
Interesting. And I would imagine that most people that you talk to, you pique some curiosity. That doesn't mean they necessarily take steps that help them to improve their business, but most likely at least plant some seeds and help them to improve. Because like you said in the beginning, most people should be willing to learn and to listen and to change. But again, human nature being what it is, and to a large extent, even though we're in separate industries, it comes down to working with people.
Absolutely.
So, yeah. So, Chris, thank you for your insights and your expertise, and as Mike indicated as well, thank you for your service, and hopefully you never tire hearing that. Yep. Thanks for everything, and thanks to our listeners for tuning in, and hope you picked up a few points. Next week, guest is Kirsten DeFleury with Dan White Associates, a financial advisory firm, and see what she has to say. And again, thank you for listening, and we'll see you on another show.